So good afternoon, the respected participants for this important webinar being held under the Committee of Management Accounting. Management Accounting Insight Credit Risk Management. Friends, we all know that the credit risk is the one of the oldest form of the risk being undertaken by the bankers especially. And credit risk is in various shapes, in various forms. And this is the practice of the professionals to how they mitigate the risk and what could be the level of it. We can't say that risk could be eliminated at length, but with the practice, due diligence, and a sort of practices which we could take in mitigating the risk, we can reduce the risk as well as we can minimize it. Hence, credit risk management is practice of mitigating losses also. Credit risk is such a risk which could be analyzed before funding also. So there could be, sort of various parameters before the risk comes into the system, and even after the risk is originated, then how we could reduce it. Today's program is being, blessed with Bihari Lal Deora ji, who is a learned speaker on the topic, and who has been kind enough to join hands with ICI from time to time and give his precious time for the professionals at large. So, with a brief introduction of Deora ji, I would like this program to be started. So, Bihari Lal Deora ji is a FCA, CFA, and CIPM, and he's an accomplished finance professional with his global market expertise. He is also a subject matter expert across a range of tax, accounting, pension, risk management, and capital market policies. Mr. Deora is regular visiting faculty for advanced finance programs and currently pursuing a PhD with Symbiosis University. He began his career as a financial analyst at Credit Suisse and Fidelity Investment, amongst others, where he gained knowledge across a range of sectors, including oil and gas, commodities in the US, Europe, and Asia, and holds a Master in Commerce degree from Veer Narmad South Gujarat University, amongst being a rank holder in Chartered Accountancy course and Certified Financial Planner, CFA Charter holder, and other certificates. See, such a speaker who has a multi-diversified experience as well as a wonderful orator. I have been, part of Deora ji few times. So this is our honor that he is deliberating on the very important topic, that the risk management. So friends, I will not take much time. I welcome each and everyone on behalf of myself and also on behalf of the CMA. So over to Deora ji, and I hope that each one will be benefited by the wonderful deliberation of Total Learned Speak. Thank you very much.
Thank you, Gyanji, and thank you to CMA for offering me this opportunity to give back to my alma mater. To begin with, I did my chartered accountancy. That's the base of everything which you do in life. So credit risk and etc. can be topped up, but CA is obviously to begin with where you learn the most. Allow me a moment. I'll share my screen, and then I think we can get started. All right, I think my screen is visible to all of you. We will obviously have some time towards Q&A at the end, and CMA will obviously forward you the material copy for your perusal at a later date. So bear with me while we cover up this session. Like Gyanji mentioned, I did my chartered accountancy way back in 2003, and since have been practicing in credit risk, financial analysis, and other area. Currently, I work with a firm called Abacus Asset Manager LLP, where I look at risk and compliance apart from other functions. On credit, what we are trying to cover today is we'll try to understand the credit rating basics in terms of what kind of models most rating agencies or banks used when they do credit appraisal. We'll talk about how credit strategy is being used from a portfolio management perspective, which is usually from a fixed income investment that is done by insurance or mutual funds. We'll also talk about trades from a bond manager perspective. Obviously, markets in India are not very developed, but across the world, how credit market functions and how the trade happens. And if need permits, we obviously will cover the credit enhancement and tools perspective. A little bit of background on the history of credit rating agencies. You all have heard of, Moody's. So Moody's started way back in 1909 in US when they started rating railroad companies. 1916 is when Standard and Poor's came in picture, and 1924 is when Fitch started rating companies. And 1930 is when officially the federal regulator, which is the equivalent of Reserve Bank of India in US, started using some of these ratings to evaluate the bonds. So you see in the US, the ratings are almost, a 100-year-old phenomena, and they've been used extensively for a majority of the things with respect to credit. A short history on Indian rating agencies. CRISIL, which is affiliated to S&P, started in 1987. ICRA, which is affiliated with Moody's, started in 1991. Fitch India, which is now renamed as India Rating, started later. CARE is somewhere similar, I think 93. And then there are other rating agencies which keep on getting licensed. So there are very few, but obviously there are some of them. So in India, the history for credit rating is barely 40, 45 years old, versus rest of the world, where obviously you have data availability going back to 100 years for credit defaults and some of these parameters. I put in a small picture in terms of when do you need rating. So whenever we talk about rating, by default we talk about credit ratings, right? Now, in current scenario, ratings can be required when you are raising money, when you are looking to onboard a client, when you're looking to merge with someone, when you are doing vendor due diligence, personal finances, you have something known as a CIBIL or a credit score. So it has variety of uses with respect to when the credit rating is required, whether it is only for capital raising or other cases as well. In general, this is a classic question whether the rating can be used. Rating is a recommendation, or is that an opinion? Is that used as an input to decision making, or is that the final word? So if your credit rating is BB or single B or triple B, does that determine whether you will get the credit or not, or are there other factors which can play a role into this? And we'll come back to answer this question towards the later part of this session. But this is a classic question and a classic issue why a lot of these NPAs happen. Where credit rating is used whether as an input for decision making or recommendation. The other question which comes to your mind is whether the credit rating is an art or a science. Are there fixated formulas which can be used to determine what your credit rating is based on your financials or other data which is sacrosanct, or is there a subjective element involved in credit rating which can help you determine whether the qualitative aspects of a business can be factored in, even though the businesses are making losses from that perspective. Now, having gone through that background, typically you refer to any credit textbook, you will end up looking at a C model, right? Now there are multiple models. If you Google it out, you will find 4C model, you will find 5C model, 6C model, 7C model. But the fundamental model remains is a 4C model, right? You find out any word in finance which starts with a C and you add to it, you can make a model out of it, right? But fundamentally, every credit textbooks will definitely cover these 4 Cs which you're going to talk about. Now, whether you are on the buy side, on the sell side, on the rating agency, or any other place, as long as you take care of these 4 Cs, you will end up, doing your credit analysis right. The first C, obviously, here is character, which refers to your ethical reputation, business qualification, and operating record of directors, managers, and executives who are responsible for borrowing and repaying the fund, right? Now, if I give you, names of few corporate houses, maybe SR or Tata or Reliance or Birla, you already have an image of some of these businesses. You already have a reputation of some of these businesses, which is based on the track record of the promoters, the reputation of the businesses being successfully run by some of these families, or the qualification of people who have been running this, or the track record of successfully executing some of these projects by these promoters, which collectively determines that, there is a character for a company. An individual character can obviously be identified based on a variety of things, but for a corporate, how do you determine the character, right? And character essentially refers to your willingness to pay. irrespective of your ability to pay, which means that, you are true to your word. If you say you will pay irrespective of whether you have money right now or not, right? And for majority of the lenders, character is obviously the most important variable. If there is a tick mark on character, then yes, they'll go ahead. Otherwise, they'll not go ahead. Now, different rating agencies obviously uses different parameters for identifying character. But I've given an example from Moody's, which try to assess management quality by looking at strategic direction. So if you look at the annual report of, let's say, a Tata or a Reliance way back in early 2000, Tata would say that we will go and expand in multiple geographies to multiple countries, multiple geographies, and 10 years down the later, you will see that they have acquired Jaguar, or they have sort of expanded, into steel business or other businesses outside. You look at Reliance annual report, they'll say that we have a vision to get into telecom, we have a vision to get into financial services, etc., etc. 10 years down the line, you will see that they have, Reliance Retail, Reliance Jio, Reliance, Phone, etc., etc. So what is the vision of management? Sometimes they will say that we want to be Fortune 500 company. Sometimes they'll say we want to be number 1, 2, 3 players in this company. So what's the strategy direction where the business is going, right? Does the management have a clarity in terms of what they want to do, where they want to do? In terms of financial philosophy, whether they are conservative, whether they are aggressive, whether they are kind of more debt takers, whether they are more equity takers, that will determine whether the businesses or the people who are running, whether what their philosophy is, right? Importantly, also the track record. Have they executed successful projects in the past? Have they done, some of these businesses well? Have they grown businesses? Have they turned around businesses? These things obviously are seen when it comes to management from that perspective. Similarly, any company can do well if there is a professional management, if there is a succession planning, right? Tomorrow, if let's say Mr. Ratan Tata is no longer there, the businesses of some of these companies will still run, right? Same is the case with Reliance or some of the other companies where even if the key man is not there, the business will still run. No doubt it's a personal and a professional loss to the strategy of the company, but the business will continue. Business will outlive the life of the individual. So whether the businesses have successful succession planning in place. You'll recall that a lot of these banks hesitate to give loans to some of these individual proprietors, largely because they don't have succession planning. And the final thing is control system. What kind of controls, checks and balances are in place at companies' premises or companies' plants, which gives them a reputation whether the management really cares about their businesses or not, right? So when referring to character, we are obviously looking at willingness to pay, irrespective of the ability to pay. Now, the other C which comes in, which is kind of fairly quantitative, is the capacity to pay. Capacity to pay is nothing but generally the cash flow ability of the issuer to repay its financial obligation, right? So you look at for individuals, you look at your salary income, you look at your cash flow, you look at your profitability, and you likely find out whether you have sufficient net worth, which is kind of liquid, and obviously which has strong market value, or your funds, whether they are cash sufficient to meet the interest and principal payment, right? This is very, very sort of, simple terminology, but this only is one pillar of the entire credit analysis, apart from character and other 2 C's, which we're going to talk about. Now, capacity of your business may be X, but it can be amplified or de-amplified basis certain factors, right? What are those factors? Let's talk about it, right? Now, industry trends. Now, if you are in an industry which is kind of more susceptible to economic cycle, which is kind of, which is more susceptible to sort of technological changes, right? Even though you are making good profit right now, your capacity will be treated as lower from a future perspective because you're more vulnerable to economic cycle. When the economic cycle is bad, your company will do bad, vice versa. When you're doing good, it will do good, right? So there's not a steady stream of cash flow. So from a future projection perspective, even though you're doing good right now, for future, it will be considered as a different. Other example could be a paper industry where, right now there is a demand for paper because of education, because of packaging and other things. But eventually at some point in time, people will move online in terms of content consumption or textbooks or notebooks, and the reduction of paper will happen. That will deteriorate, how these companies are performing. So is the case with newspaper companies, like how many people are still reading newspapers, physically, right? They are reading newspaper, but the consumption mode has changed, right? Second is your regulatory environment. Now, certain times, you are in an industry which is very, very highly regulated, which creates as a barriers to entry for anyone new to get a license. Take an example of a telecom or a electric company. So, for example, in Mumbai, you have BSES, which is obviously now taken by Adani Power or Tata Power. Now, there are only two utilities in Bombay or Mumbai, and it's very difficult to enter into that business given the regulatory hurdles it has. Or maybe you have a pharma plant where you require an FDA approval, or some other plant where you require a government of India approval, which is very difficult to get. Right now, if you are in a industry which has a regulatory advantage to it, then irrespective of whether you are making profitability right now or not, your capacity will be higher because you will consistently make those margins even if they are low at any point in time. The third is obviously basic operating and competitive position. So if you are at a place where your costs are very, very low, your costs are very, very minimal, right? You will obviously become the price leader at some point in time, right? Now, you obviously understood the Make in India concept from that perspective. But take an example of an Apple or a Android phone. Now, for Apple, Apple is a price leader from that perspective, right? They can charge high premium to their products, even though their cost might be same. So if your cost is X, but your price which you're charging is 2X, eventually your profitability is higher and hence your capacity will be higher. Vice versa, if your price is, let's say, X, but you can manufacture at, let's say, 0.5X, whereas everybody else is manufacturing at 0.8X, then you are a competitive leader, and then you can obviously increase your capacity from that perspective. Similarly, you have financial position and sources of liquidity. Majority of the IT companies typically try and keep 1 to 2 years of cash expenditure on their balance sheet as a contingency reserve. And some of these companies are net negative from that perspective. And that will essentially give you a perspective that, fund whether the company will be able to repay in case of an emergency. And that will strengthen your capacity, even though when you're not making profitability at this point in time. Sometimes it's a company structure or a parent company support agreement, which would mean that even the company which is launched is new, but the parent which is out there can support this in case of an emergency. So tomorrow, if there is a new company called Tata Cycles, just hypothetical example, that the parent is very, very strong and they can come to rescue this company if this ever goes into trouble. So such kind of financial backup will always act as a incremental capacity from that perspective. And a lot of times you might have a special event risk. So for example, you talk about, let's take an example of, an Imagica water park, right? The Imagica water park is located in the middle of Lonavala, somewhere in hills. There is a risk that if the earthquake happens, the park might go under, like the companies which have financed this park might go under. Or take an example of the refineries or ports which are out there, which has a lot of debts, from that perspective, or airports, right? Now, some of these events risk can be mitigated by taking insurance on some of these projects, which will essentially enhance your capacity. The third C which we talk about is collateral. Now, collateral is nothing but something which provides an additional cushion. Additional cushion against what? Additional cushion against operating performance. Additional cushion against management decisions, right? You can call it security, you can call it mortgage, you can call it pledge, but it is an additional security in case whatever business against which the loan was given is not working out or is unable to repay, the lender can essentially encash this collateral, from that perspective. Now, there are a few kinds of collateral which is not considered as a good collateral, right? A collateral obviously has to be liquid. A collateral has to be marketable. But things like fashion items, things like high technology equipment, they are very poor collateral or protection for the firm because the value of these things depletes every now and then, right? Now, you might argue that an item of fashion might be an art and artifacts, and that might, have its own value, but it's not liquid from that perspective. So you look at real estate, there is no daily value, but it's still liquidatable, right? You look at shares, they're even more liquid from that perspective, right? So if the debt obligation is kind of, secured or unsecured, then the proceeds of some of these collaterals will help them, cover up whatever obviously they have in terms of principal or, analysis. Now, depending on the business model, depending on the company, sometimes you place higher value on collateral, sometimes you place lower value on collateral or lower emphasis on collateral when it comes to loans. So for example, you take any example of home loan, right? They're always collateral driven, right? Irrespective of whether you have, character and capacity, they will still keep, the house as a mortgage or a collateral And typically they'll try and mortgage or give you loan for only 75% of the value, so that in case something happens, they can recoup the value from that particular home. The last C, which we'll cover today, is governance. Now, covenants essentially are conditions. Covenants are limitations. Covenants are, restrictions which are imposed by lender on borrower's activities, right? They provide protection to lender because they don't allow the borrower to do things on its own, right? It allows or it forces the management to conduct its financial affairs in a prudent manner in some of these scenarios, right? So, for example, if your company is in debt burden, is unable to service, let's say, loan, why would you allow your company to pay dividends, right? So, if you don't allow your company to pay dividends, that will essentially become a condition which they have to abide by. Now, covenants could be of different types. It could be negative covenants, which means that you can't do this, you can't do that, you can't do X, Y, Z, right? Affirmative covenants are covenants which requires you to do something. For example, you have to get it insured, you have to get it audited, you have to submit it on time, right? Restrictive covenants are covenants which are kind of, doesn't allow you to do something, which means you can't do additional capex, you can't, buy a company, you can't, sell an asset, etc., right? And financial covenant could be any other ratio. The ratio could be maintain a debt EBITDA of 3.0, maintain an interest cover of 2.0, etc., right? So depending on where the covenant fits, it will fit in one of those categories and basically give you a perspective whether the covenant is positive or negative, right? Whether you call it whether you call it conditions, whether you call it features, or whether you call it covenants, they are pretty much one and the same from that perspective. Some of the examples of covenants which we discussed about, so it could be limitation on borrower's ability to incur additional debt. It could be fixed charge coverage ratio, interest coverage ratio, limitation on dividend payments, stock repurchases. It could be indentures prohibiting, subsidiary to borrow, also the parent to borrow, paying interest on timely basis, paying taxes on timely basis, keeping assets in good condition, submitting periodic reports, etc., right? So we covered 4 C's today. One obviously is your character, which is your willingness to pay irrespective of your ability to pay. Second is your capacity, which is your ability to pay irrespective of your willingness to pay, right? Third is your collateral, irrespective of your character and capacity. If the borrower needs something else, it is collateral. And the 4th C essentially is your covenant, the conditions which you should abide by during the subsistence of that particular loan on the activities of borrower by lender, right? So this is the classic 4C model. You can always add more C's to it, like how much capital you have, how much cash you have, etc., and make it like a 5C, 6C kind of a model which can work, right? Now, we talked about, credit analysis, so one important thing essentially which comes is ratio analysis, right? We talked about that you need to identify the capacity of the borrower. Now, how do you identify the capacity of the borrower? For identifying the capacity of the borrower, you look at profitability ratios, what kind of profits it is making every year. It could be, your gross profit, your EBITDA ratio, your ROE, ROA, ROCE, etc., It could be a turnover ratio in terms of, debtor turnover, creditor turnover, working capital ratios, and debt coverage ratios, which are kind of more with respect to total cash flow or free cash flow, etc., right? There could be some sector-specific ratios, which are kind of debt by reserve. So if you are an oil reserve or a mining company, we would want to find out that what's your reserve per barrel or per ton of whatever reserves you have. So, for example, if your per barrel, debt is about, let's say, $50, and the cost to take out that, oil or that reserve is another $30, right? You are looking at $80 just to basically recoup the entire thing. As long as the oil or whatever that reserve is trading at above 80, you are covered. But if it is below 80, then that security or whatever you have is not sufficient to cover up your cash flows for the future. So any kind of sectors, you can always have customized defined ratios, which can be used for analyzing some of these sectors. I'll give you a table which essentially you can look at on your screen. These are indicative ratios. This is obviously industry comparative ratio analysis across ratings, right? So you can look at ratings in US, ratings in EMEA. Unfortunately, I don't have APAC data, but you can look at data across. Tell me if you see any discrepancy here. So if you look at these ratios, you'll notice as the rating goes down, the ratio also keeps on deteriorating, right? So for example, EBITDA margin, for an EBITDA margin, the AAA companies have a ratio of about 30%, whereas a single B company has a ratio of about 20%. Return on capital for a AAA company is about 37%, whereas for a single B company, it's about 8%, right? And similarly for debt EBITDA, so the coverage of some of these companies is about 0.4 at a AAA level. They hardly have any debt, whereas talk about single B companies, they're like 6-7 times levered in terms of EBITDA. You'll notice in some of these ratios, even though the rating is higher, the ratio is lower in those categories. So if you look at EBIT interest coverage on a AAA, it's about 60 times, but on a AA, it's about 16 times. Whereas the single A rating companies are about 22 times. Now, how could this happen? This can happen primarily because of two things. One, obviously, this is a average data for the sector. So sometimes some companies in sectors are not doing well, and hence, even though they are rated higher, at this point in time, the economy is not doing well or otherwise. The rating may be driven not just by ratios, but by other factors, which is collateral or some of those things. So hence the rating has not changed, but the ratios are completely depleted, right? Second, it's an average of 3 years, right? So, if you look at year-on-year basis, the trend will continue, but otherwise, sometimes the average might throw something which you don't want to hear. Similarly, if you look at, the table which I showed you earlier is essentially for S&P. This table which I'm showing you is for Moody's, right? So there you will see the AAA coverage or AAA sort of, companies have an operating margin of 20%. Now, if you look at the previous table, the AAA companies have an EBITDA margin of 29.6%, whereas Moody's says that they have an operating margin or EBITDA margin of 23%, right? Now, you notice the difference. Moody's is using a definition of EBITDA. They are not using depreciation here, whereas S&P is using EBITDA, which includes depreciation here, right? And same is the case for any other ratio, which is EBIT interest coverage or FFO interest coverage or average assets of EBITDA or something. If you notice or if you believe, there are about 20 different definitions of interest coverage ratio alone, across rating agencies. Each rating agencies have their own definitions. The textbooks have their own definition. So when you're looking at a rating and you are looking at the ratios which are calculated by a rating agency, you really don't know what calculation methodology they have used, right? And hence it's very difficult to compare ratios across rating agencies to see that why this rating agency has a lower ratio or a higher ratio, because they're using different definitions, right? Overall, everybody obviously tries to determine the capacity, of the person, but the ratios might tell you a different picture depending on industry or depending on rating agency itself. Similarly, this table you'll see they're looking at capex to depreciation, they're looking at revenue volatility, they're looking at debt to EBITDA, etc., etc. So debt to EBITDA here, it's about 1 time, right? Whereas debt to EBITDA there is about like 0.4 times, right? One difference is these numbers are ending obviously December 2010. So these are a year older number than what S&P has. But you will notice some of these differences when we talk about ratios from that perspective. Okay, so you covered your 4C analysis. You obviously know what kind of ratios and what kind of models are being used. Now, how does the rating process work? The rating process essentially works with what you call as a risk factor analysis or identification of risk factors analysis, right? Where you try and identify what your business risk factors are, what your financial risk factors are, what your industry risk factors are. Just give me one moment. Sorry about that. So you look at your identification of risk factors, which is business, financials, and industry. And you also look at protective factors, what kind of regulation protection you have, what kind of barriers to entry you're looking at, and other things, right? That will give you a perspective with respect to what the overall scenario looks like. Now, in economy, you would have learned something known as the Porter 5 forces. The Porter 5 forces is something similar to what rating agencies do when they look at risk analysis here, right? You look at past financial statements, which is mandatory. Of course, you look at how the history of the company or the corporate has been, but you also look at projections. You look at projections and how the company is going to obviously, be from that perspective. The funny part here is that the projections are essentially given by the company themselves. The rating agency themselves don't do projections, right? The company will give them projections of what they think is going to the future, and rating agency will essentially use them with or without discount of that perspective. And if there is a difference in what rating agency is given, then obviously there's a difference in what rating agency is using, right? You also do what you call as a scenario analysis or a sensitivity analysis in terms of what if. So, for example, Brent crude is currently about $83 a barrel, right? Now, if crude goes to $100, which companies in India will benefit? The companies which are in refining or the companies which are in manufacturing. So, for example, ONGC might benefit if the crude prices go up because ONGC essentially is a producer of crude, right? Whereas there might not be a benefit for refining like IOCL or Reliance or some of those kind of cases. Similarly, if the crude prices goes down, who will benefit? Assuming the retail prices are not reset. If the crude prices goes down, obviously the refiners will benefit the more, right? And you also sort of try and identify the stress case scenario. So, for example, if you say, okay, I'm going to have 20% market share, what if you have 20% market share or 10% market share? What if your cost of production goes up? What if your labor cost goes up, etc., right? You also include what you call as the qualitative parameters. So qualitative parameters is the character aspect which you talked about. This is very, very difficult to quantify, but you try and get a judgment on what the ethical reputation of that business is and try and include that in the rating. And finally, what you decide to give you a rating, it's a judgment on the relative ability, which means you are comparing this versus someone else. It is never standalone rating. It is always a relative rating, right? You're looking at a sector, overall sector has some data, and then you're looking at whether this company is above sector, beyond sector, better than sector, or some other sector, right? So it's always some of these factors which are used when you do rating analysis. Now, on your screen, what you see is essentially a rating model, which I've taken from a Moody's, report on Reliance, right? Now, you look at there is a model out here which talks about 4 different factors. You'll see factor 1, which is scale and diversification. You'll see factor 2, which is profitability. You'll see factor 3, which is financial flexibility. And you'll see factor 4, which is essentially institutional support / constraint, right? So factor 1 essentially calls scale and diversification, and scale and diversification essentially has a weightage of about 35%. And what they tell you is that they have a crude distillation capacity of 1.2 million barrels a day. They have a complexity barrel score of 15,624, and they have large scale refineries value as 4, right? Now, for the first category, which is the capacity, if majority of the companies which have capacity of about 1.2 million barrels, they are rated about single A. So the mapping here done is single A. Similarly, on a complexity barrel, what is complexity barrel? Complexity barrel means that you can process dirty crude. So there are 2 kinds of crude, light crude and dirty crude. Light crude is the crude which is available on top of our oil well, and dirty crude is which is at the bottom of the oil well, right? So as you grow towards the bottom of the oil, there is more dirt, more kind of mixtures in the crude which needs to be refined. Now, if your refinery is complex, based on complexity barrel, you can define more dirty crude and still come up with the same output of a petrol or a diesel or something, right? And dirty crude is usually cheaper than the light crude, from that perspective. It's ironic that 2/3 of the world's reserves are dirty crude and 1/3 of the reserves are light crude, whereas 2/3 of the refineries set up in the world are can only process light crude, and only 1/3 refineries can obviously process the dirty crude, right? Reliance obviously has one of those refineries which can process dirty crude as well. Hence, from a complexity barrel perspective, the mapping here done is AAA, right? Now, they only have one refinery at one single place, at one single location, right? And based on that, that's the bigger risk. If something happens at that location, then obviously the refinery closes, right? So based on that, the rating mapping is BAA. Then you'll see the profitability ratios where the ratings are in AAA, in debt it is CAA, in coverage or RCF it is again BAA. Then you have institutional support / constraint in some other group companies, that is again BAA3. Then you'll see what is there, something known as a rating indicated from grid, which is A3. An actual rating assigned, which is BAA2, right? Now, A3 essentially comes above, BAA1, then comes BAA2, and then comes BAA3. So you're looking at the model is saying that the Reliance rating should be A3. But the analyst who has determined the rating is essentially giving a rating of BAA2. Now, the question might come to your mind in terms of if analysts has got this rating from that mapping, why the actual rating is lower, right? Few reasons for this. One, India has a sovereign rating of Baa3, right? So typically, most companies cannot have very, very high or very, very different rating than the sovereign ratings of India, right? Except if the companies are mostly export oriented from that perspective. And there too, it cannot be very high, more than 1 or 2 notches from the country itself. And you will see Reliance Refinery essentially has a lot of these exports from crude, and hence the rating is a little bit higher than the sovereign rating of India, right? Second, remember the character aspects of rating, which we talked about, where we say that it's a qualitative input which can be incorporated in the rating and not an actual, quantifiable number. That obviously plays a little bit of factor here. And third is, analysts will typically be more conservative in assigning rating because a downgrade from A3 to Baa1 will raise more questions than an upgrade from Baa3 to Baa2, right? And hence they will try to be more conservative and give 1 or 2 notches lower than what their database is showing, because the data keeps on changing every year and they don't want to change ratings every year, right? So now similar kind of models can be developed for any industry, right? And these kind of rating methodologies, they are available on every rating agency's website free of cost. You can download and try and understand how they analyze a particular company. So tomorrow, if you are financing or helping finance, or you are a CFO of one of those companies which is looking for a debt, try and look at rating methodology of any rating agency on that industry, and you'll understand what all things they look at when they look at rating you, and what all things will impact your credit cost whenever you are trying to do this financing. Similarly, you look at this peer comparison. So in peer comparison, what they have done is they have tried to compare Reliance with other refinery and marketing companies across the region, across country, and across the world. So you look at Reliance, they compared it with IOCL, which is an Indian company. They compared it with Thai Oil, which is Thailand, PTT Aromatics, which is Malaysia, S Oil, which is Korea. PTT again Thailand itself. And they looked at SK Innovation and Valero, which is in Korea and US, and they've tried to compare it across the universe. So you see, Indian Oil also has a capacity of about 1204, which are almost 1.2 million barrels a day, equivalent to Reliance. But you look at the complexity barrels. The complexity barrel for Reliance is like 15,624, but whereas for Indian Oil it's about 5,278, right? Reliance obviously has single locations, but Indian Oil doesn't have single locations. The Reliance margins is much higher because it can produce dirty crude, take dirty crude and produce the same oil, whereas Indian Oil has it lower, right? You look at across the world, the EBIT is highest with respect to Reliance. Now, in terms of complexity barrel, you look at Valero. Valero obviously has 26,910 complexity barrel value, which is far, far higher than even Reliance from that perspective, right? But their EBIT is very, very low because their debt, again, their debt is similar or lower than Reliance, but their other expenses, or the size of the refineries are very, very small, right? So from that perspective, obviously they are unable to justify some of these additional profits, and hence a lower rating from that perspective. So typically, like I told you, rating is always the relative ability to pay debt, and when you talk about relative, you look at local companies, you look at regional peers, and you look at international peers from that perspective. Now, question of the day is, what is that one alphabet which is liked by all of you, but no matter what age group, what financial and non-financial, whether student, professional, whether work, study, etc., etc. And without much ado, that letter we are talking about is A, right? Have you ever wondered why the rating started with the word A? Because we all like the word A. We like to be in A class. We like to be in A category. We like to be in A zone. Hence, the rating essentially starts with sort of AAA ratings. In theaters also, A row is always at the top from that perspective. Your grades, your performance appraisals also A from that perspective. And we obviously all like Apple in America. But anyway, jokes apart, the global rating agencies, obviously the Fitch, S&P, and Moody's. This is the rating scale they operate. So you look at Moody's, it's AAA. AA1, AA2, AA3, A1, A2, A3, and then Baa1, Baa2, Baa3. S&P is AAA, AA plus, AA, AA minus, A plus, etc., etc. Fitch is similar to S&P, right? Why Moody's is different? Because obviously Moody's started first, so they had the privilege of doing whatever they want. And later on, whoever came, he had to differentiate themselves, so they started with something else. But the third person didn't have any option, right? So they had to go by one of them, and Fitch chose to be similar to what S&P was doing. So any rating which is above Baa3 is essentially considered as an investment grade rating, and any rating which is below Baa3, which is Ba1 or so, is considered as a low grade or a speculative grade, rating from that perspective. India obviously currently is at BBB minus or Baa3, which is just above investment grade, just above that junk rating, and on the verge of getting upgraded whenever it can. So the above category are known as high quality or investment grade companies. The below are known as junk or high yield market, which obviously the rates, etc., would be higher from that perspective, right? A typical rating process would include requests from issuers, unsolicited ratings, evaluation by team of analysts, independent rating committees, acceptance, non-acceptance by management of a rating, request for a review, surveillance of accepted ratings, and a credit watch. Now you can argue if management only has to initiate rating, where is the question of getting unsolicited rating, right? Can a rating agency rate a company suo motu? Now, majority of the cases, this might not happen. But sometimes, let's assume the rating agency is new. If the rating agency is new, it is keen to cover, the market. And for that perspective, it will try and cover some of the well-known companies in the market free of cost based on public information, so that they can at least namesake say that we rate, 5 companies, 10 companies, 15 companies, right? And from that perspective. So sometimes you do get, some of those unsolicited ratings out there. India, obviously, we haven't seen many cases, but outside India, this definitely is out there. This is a standard rating process, more in a flowchart perspective, which I've shown you. But each rating agency will have something different. There is a rating agency committee. There has been a lot of to and fro and cases where rating agency has been questioned on the decisions, and the mishaps which might have happened in credit. But eventually, you have to understand, it has to be used as an input to decision making and not a recommendation. A rating agency is also giving you opinion, right? Saying that, look, basis my knowledge or my analysis, this is the risk going to be. Eventually, you have to identify whether you're comfortable playing that risk and giving whatever loan you want to give at whatever yield you want to give. And if you're not comfortable, please don't give. But eventually, don't blame rating agencies saying that because the rating was high and because they couldn't catch what they should, eventually this happened. And remember, I told you the rating agency gets financial and other inputs from company itself. So, they are also not bloodhounds. They're also watchdogs like, us. This is a typical fee structure. I mean, I populated a couple of years ago. This must have changed, but typically the rate, there's a minimum fee and then there is a percentage of outstanding amount which goes under from that perspective. So we discussed that rating is an input to decision making. It's not a recommendation. Be buyers, be aware if you are obviously relying on rating. Rating is usually for debt, not for equity. So when we talk about rating, it's always credit rating. Higher rating would mean zero risk or low risk. Higher rating would always mean low risk, but not zero risk. The fact that he has taken a loan, he always will have a risk. Now, whether the risk is low or mitigable is a separate story, but he still have default risk. Rating is prospective because it looks at future data. It is interactive because it includes some of these interactions with management, and it is qualitative and quantitative, right? Some of this which cannot be explained in numbers, right? So there is a bit of subjectivism in there. And the last is rating is a relative assessment, which means that it is always a relative ability versus some other company, and not a standalone, rating, which makes it difficult when you're looking only that particularly and not bothered about rest of the sector or companies where the sector itself doesn't exist, right? Okay. All right. So let's try and see if I want to straight away come to question number 3 and see what your view is. If the management is of questionable character, how can investors incorporate this assessment into the credit analysis and investment decisions, right? A, they can choose not to invest based on increased credit risk. B, they can insist on getting collateral or demand a higher return. And C, they can do both, right? So this pretty much explains what a rating agency is essentially giving you. Rating agency is giving you a higher risk based on XYZ. But eventually the investor has to decide whether they want to invest or not, and whether they want comfortable with taking on that risk from that perspective. Now, whenever we talk about ratings, we always talk about, senior unsecured rating, right? Now, in a company's, waterfall or, bankruptcy waterfall, you have majority of, ranking order or a pecking order, right? So if you look at our liquidity proceedings, you always get employees due first, which is PF, gratuity, etc. Then you get income tax and government dues or GST, etc., etc. Post that you clear up working capital, and then you come with first secured and second secured and third secured. Then you go for unsecured, then you go for mezzanine, then you go for preference share, and towards the end you go for equity, contribution from that perspective. So whenever we talk about credit rating, whether it is Baa1, Baa2, we're always talking about senior unsecured, or general unsecured rating, right? Because if it is secured, the rating would be higher. So general unsecured rating is what we are talking about, right? And the higher, if your loan is secured and higher than unsecured in terms of pecking order, then obviously the rating would be higher. And if it is lower, then the rating would be lower. Clear? So you look at the example of this company, it has a corporate credit rating, which is single B. It has a preferred stock rating, which is triple C. It has a senior unsecured rating, which is single B. And it has a subordinated rating, which is triple C plus. Now, if you look at the pecking order, the senior unsecured rating and the corporate credit rating are essentially usually the same, because company's rating is always determined by its unsecured sort of rating, right? Preferred stock is even below that, right? It is just above equity. And in between, you have subordinated. So you'll see subordinated rating is triple C plus, preferred stock is triple C, and then below that is obviously equity from that perspective. In between, you see this stable. So stable is essentially the outlook. Outlook could be positive, negative, stable. And the last is obviously you see a dash there. The dash is essentially for short-term rating, which is P1, P2, P3, or F1, F2, F3, or A1, A2, A3, right? The short-term rating is essentially for instruments which are less than 1 year, whereas longer-term rating is for instruments which are more than 1 year, right? And between that 1 year, if anything is going to happen over the next 6 to 12 months, that's your outlook which you put in, right? So from a rating agency, whenever we're talking about rating, it's always the unsecured rating, right? Now, you would have noticed that, Reliance Industries or any other company you take, the CRISIL rating for that company is AAA. Whereas the Moody's rating for that company is Baa2 or Baa3, whatever rating you call it, right? Why would there be differences in two different rating agencies when, both of them are looking at same numbers or same financials of the same company, right? So the answer to that question is that the local rating agencies are rating your local debt, which is rupee denominated debt. And when you are basically, covering your rupee denominated debt, you are essentially looking at companies which are in India to do a benchmarking. And hence, within Indian companies, this obviously is the best company and hence a AAA rating, right? When it comes to Moody's, S&P or Fitch, they are looking at foreign currency exposure of that company and foreign currency rating of that company in dollar, right? And in that scenario, they are covering or looking at companies which are in similar sector or otherwise, but outside India, right? And hence that rating is always going to be lower than the, rupee rating. A country most likely will never, a country or a company will most likely never default on its own bonds or local currency bonds, because that's where, they survive or they stay day to day. If they have to default, they'll default on the foreign bond first and then on the Indian bond, if at all that happens, right? On the screen, you will see a chart which, is for a bond of Ford Motor Company, right? It has senior unsecured debt. You will see the ratings are given based on the time frame from 2005 to 2011. You will also see that the prices have changed, basis the rating. The question I have to ask you is whether the rating precedes the price change or whether the prices precedes the rating, right? Has the prices changed because the rating had changed, or have the ratings changed because the prices have changed? And you will see both of them happen simultaneously. Sometimes the price have gone up before the rating, has improved in the anticipation, because rating happens as a post-mortem and not as a pre-factor determination. And sometimes, prices have only reacted after the rating downgrade because, the market anticipation risk has increased with respect to that particular stock. So when you look at S&P Moody's scale, investment grade bonds typically carry rating from AAA to triple B minus, right? Triple B minus to triple C will be non-investment grade, right? Now, a lot of times you look at rating for two rating agencies. Now, which of these is considered as a junk? Now, if you look at case C, it has one investment grade, which is Baa3, and one non-investment grade, which is BB plus. So that is like a 50-50 case. But classic case B, where both the ratings are below the investment grade, is considered as a junk rating from that perspective. We have explained about the differences between the issuer and issue rating. These are essentially, senior unsecured rating. Now, this is interesting. Given a hotel company, a chemical company, and a consumer product company, which company is most likely to be able to support a high debt load over an economic cycle, right? So you're looking at three different companies: hotels, chemicals, and consumer product. And you're looking at companies which can go through a consumer cycle and still carry a high debt load. So the answers are hotel company, because people need a place to stay. You've seen what happened during COVID. Hotels are completely empty. So hotel obviously is not the right answer. Chemicals are a key input to many products. That also you have seen that chemical plants were closed for some time, and if the plants are closed, nothing can happen. So that also is not a right answer. That is also not a recession-proof business. And the third is obviously consumer product company, because they are recession resistant. I mean, even during COVID, the essential services was on. You are required to eat, and you're required to do whatever is required to survive. So the answer to this question obviously is the consumer product company, which can survive a high debt load over an economic cycle. Now, the other question you will see here is, why do heavily regulated monopoly companies such as utilities carry high debt loads, right? So remember, in capacity, we talked about regulatory factors, that if the regulations are such that there are entry barriers, these companies will have a high shelf life because they continue to get cash flow over a period of time. Imagine that you are an electric company, even though you might be in losses, but every month you will get your money from customers, right? So it's a strong and stable cash flows, which can support you to sort of, take the high debt levels of debt, right? Other than that, there is no reason why these companies will carry high debt loads, other than that consumers will always pay their bills on time. Now, I told you India obviously has only about 35-40 years of history with respect to ratings, but globally, obviously, you have, rating history of more than 100 years. And for every year in the history, they calculate what they call is corporate debt recovery rates. Now, with the influx of IBBI in India and the bankruptcy regime, we also now have started getting this data in terms of how many companies go under bankruptcy, what's the recovery rate for some of those companies, whether they emerge successful or not, and what kind of value do you get out of that based on the type of ranking of debt, right? So you look at this data of average corporate debt recovery, measured by ultimate recoveries. If the person is defaulted in 2009, then obviously the recovery rate for senior secured is about 65%, which is 2/3, whereas for junior subordinated is almost zero. From 87 to 2010, which is a period of about 30 odd years, you will see that the recovery rate have stood close to 63.5. But you'll see that in certain years, the recovery rate also fluctuates, right? Like in 2009, the recovery rate across ratings is lower, right? Why? Because the market scenario was not good in terms of liquidating some of these assets, right? So liquidity obviously determines a few important sort of parameter when it comes to recovery rate. But average, you'll see if you're a senior secured debtor, 2/3 of your money will always recover with respect to that. For unsecured, it's all usually 50-50. And below that is anywhere between 1/3 to kind of 20% recovery, which I think people are talking about. Once company goes in bankruptcy, I think it's even lower, but these are the rates which can sort of evaluate when you look at recovery from a particular company. As India emerges and we get more data, I think we will know what recovery rates India is kind of witnessing. Now, what I've done is essentially I've taken the recovery rates and tried to put it in across periods from 1990 to 2010. The gray lines which you see behind are essentially, your recession periods, and you will see during the recession periods the recovery rates have been fairly low. Fairly low, whereas post-recovery they have essentially grown up, in numbers. But on an average, you'll see about that 65-70% number being maintained. This is again a pictorial data of global annual corporate default rates. So obviously AA, AAA, obviously you'll find almost zero. None of the AAA companies will default because before defaulting, it will go down to AA or single B and then get to default, right? So on a triple C kind of company, 1/3 companies were defaulting in 1991. In 2010, that number has come down to 22%. In years of 2008 and 9, when the economic crisis was there, almost 50% of those companies obviously defaulted, not just in that category, but also in AA categories also, right? 99 there was a crisis, 2008 then there was a crisis. Both those cases you'll see AA also has some of those annual default rates by category. What I told you about was S&P. So again, you see 1 year, 3 year, 5 year pool, you'll find some of these default rates, which can tell you what percentage of debt usually defaults. Now, there is an interesting product called CDS, which is kind of corporate default swap. It was introduced in India in 2010 by RBI. It's still not very popular. Recently, SEBI has allowed the alternative investment funds to, use use CDS in case they want to hedge, their exposure. The mutual funds and insurance companies are also allowed, but obviously they can only hedge. They can't take naked exposure of some of these products. So what a CDS does is essentially a future derivative contract. It's essentially insurance, right? And insurance on debt which you're taking, right? So if you have a debt of, let's say, 100 million and you buy an insurance of 100 million, if anything happens to that debt, the debt goes to the insurance company and insurance company will give you 100 million. In this scenario, instead of insurance, what we are talking about is that you have a broker dealer who is essentially selling you protection on that particular company. So consider it like a put option or a call option, right? So you are paying some premium. You are paying a premium which to the broker dealer, and the broker dealer essentially is giving you a guarantee that in case the company defaults, then you would get your money back from that particular broker, right? So on the x-axis, you see what the composite credit score of that particular company, and then in the y-axis you get what we call the 5-year CDS. Now 5-year CDS because it is matching with the 5-year bond, which you might have bought. Now you'll see a variety of companies over here. So you'll see US on the top left at the bottom. Then you will see China, you will see Spain, you will see Portugal, you will see Argentina. So for example, investing in Ukraine, 5-7 years ago would have required you to pay 8% every year just to sort of just to obviously secure yourself, because it was a non-investment grade company or a country. The red line on the middle of the graph, which you see, essentially divides investment grade and non-investment grade. Can you find India in it? Can you see if India is mentioned in this particular chart? You'll notice that India is not here because there is no CDS on India. India doesn't have its own CDS. Essentially, it's represented by the CDS of State Bank of India, which is considered as a proxy to India from that perspective. But this will essentially, give you a perspective on which country has what risk from a credit, perspective. Similarly, corporate yields by category. These numbers obviously, are a bit dated, but now because we are in a rising interest rate scenario, the yields have gone up completely. But you will find that Barclays used to manage some of these indices, and they still do, giving you the idea with respect to dollar yields on some of these categories. Each market have their own yields, so India yields obviously will be much different than what you're seeing in here. Similarly, you see the volatility. So the volatility is of spread, right? This is essentially like a 15-year data which Barclays have collated. So in a AAA kind of product, the average yield in return is about 4%. Average volatility in returns is about 4%. The returns don't vary much. Whereas in a CAA, the average returns will vary by about 12% or so in terms of volatility each year. Take a look at this chart. These are charts from 95 to 2011 for the global financial crisis. You'll see that the AAA spreads, which were trading as low as 100 basis point in 95 to 97, went up to about 300 basis point in 2003, and as high as 700 basis point in 2009 when the GFC had hit. At the same time, the high yield category at that point in time was as high as 25%. So if you wanted to get protection against a high yield company of a BA, or CAA, you would have to pay 25% a year in that year to obviously protect yourself. Crazy times were those. So which bonds are likely to exhibit the greatest spread of volatility, the AA, the BB, or the single A? We have written obviously that as the rating goes lower, the volatility is higher. So the lowest rating here is BB. And in that case, that will essentially will have, the higher spread of volatility. Now, take a look at this, credit curve for a moment. So what essentially it shows is you see two things. You see an AT&T credit curve. You have maturities of AT&T planted from 1 year, 5 year, 10 year, 15 year, 20 year, and 30 years. You also have a treasury curve planted, which is essentially government G-Sec treasury for the similar amount. And you see the gap between the treasury curve and the AT&T curve, the price at which AT&T is trading for a 30-year versus the price at which G-Sec is trading. That difference is essentially what you call as a credit risk spread, right? So in this case, let's say that the treasury is, trading at about 2.5, and the yield to maturity for AT&T is about 4.5, which means AT&T is spreading at treasury plus 200 basis points. That's how the credit curve is calculated. India obviously doesn't have very long maturity in terms of treasury. I mean, they hardly have 20 years for some of the bonds, but 30 is definitely not there. So the credit curve building is very difficult in India from that perspective. But yeah, I mean, we are working on it in terms of government, what they're trying to do to develop a robust debt market. Now you looked at company ratings. You obviously looked at issuer rating. Now we are talking about sovereign rating. So when countries are trying to get themselves rated, right? Moody's and S&P and Fitch, etc., would have rated India or any other country, because countries also go and borrow money, right? And some of those cases, you look at these 5-6 different scores. So you have political and economic score, you have external score, fiscal score, monetary score, right? So the external fiscal monetary is essentially what you can call it as a capacity, because you are looking at what the business is doing, what kind of imports, exports, percentage growing, GDP growth, etc., etc. The political score is what the stability of the government or the character of the government, which is being talked about, right? So you're talking about how stable is the government, democracy, etc., 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 right? And then you have, a foreign currency sovereign rating, and you have a local currency, sovereign rating, which essentially factors in when you are calculating sovereign, ratings framework. The framework is similar, only the numbers would essentially change in terms of what you're looking at. There you look at sales growth, here looking at GDP growth, there looking at number of people, here looking at unemployment rates, right? So can the sovereign exercise primary authority over recognized jurisdiction? Do they have ability to collect taxes? How is the government's? How is their willingness to pay obligations, etc., etc.? These are things that we look at. So per capita GDP and stuff like that all comes part of sovereign ratings. So take an example. I've given it to you municipal debt comparison. So in US, every state has a municipality, and the municipalities also issue debt, and they're also differently rated. So you look at California versus Texas. India, obviously this data is not very freely available, so I thought I'll use an example for US. When you look at rating difference, obviously Texas is AAA and Moody's and California is A1. The unemployment rate in Texas is lower, whereas unemployment rate in California is very high. Per capita obviously is high in California, but the total number of people or the debt burden, is very, very low there, right? Personal income obviously as a percentage is about 1.6, and 2010 GDP is 1.05. So depending on the geography, depending on the people, depending on the debt burden, the rating essentially would be different for muni to muni or company to company, right? This essentially was a old chart, which I thought will give you perspective on how the countries across the world are rated, whether they are green, whether they are blue, whether they are orange, whether they are red, and accordingly give you a perspective on where to invest in markets at that point in time. These are the debt numbers. I mean, if you go on, Economist or some of these, you will find a live debt calendar, which essentially keeps on calculating the debt of all these countries across time zones. You will find government debt of US is the highest, and then followed by Japan and Germany and Italy and Brazil and so on and so forth, from that perspective. Now, there is a correlation between GDP and government spending, and this essentially is visible from this particular chart. So you have four categories. You got established graduate, you got recent graduate, you got still in school, you got back to school, right? So depending on whether country is developed or developing or large or small or emerging, these categories are there. And the idea is that if your GDP, obviously government spending grows, GDP also will grow. And some of these older countries or developed countries, the government spending was so much on infrastructure, schooling, education, etc., that the GDP eventually, went ahead. And say so is the case with countries like UK, Australia, USA, etc., etc. This is the debt clock I was talking about, which is available on Economist, and every day, whatever credit cards you swipe, whatever bank transfers you do in terms of loans or otherwise, it gets added here, and then the clock keeps on moving. These are the number of countries in each rating category. The numbers is more or less similar. I mean, plus minus one or two. Now we looked at the sovereign and the credit perspective of sovereign and individual credit rating apart from these things. Now let's look at what a credit strategy trade might look like from a portfolio management perspective, from a someone who is on the buy side and sell side. How do they do trades when it comes to credit products, right? So I've given you an example of Australian credit rating trend tracker. So these are three factors, which is positive rating actions, which means the rating is increased. Negative rating actions, which means the ratings have gone down. And the tracker on terms of how that is happening, right? So based on this chart, what should be your outlook on further rating actions and how should you build your strategy? If your positive actions are more than negative actions, which means, more and more downgrades are going to happen, more and more defaults are going to happen. And vice versa, if your positives are more than the negative, then you know that the economy is improving, right? So in this particular case, you can see that the downgrades are more and more. They are more frequent, they're more severe, and hence, the trading action for you should be to sort of go move up into higher rating categories, because if you go into lower rating categories and if they default, then you will actually losing much of your return based on the volatility which you talked about earlier. Move up the chain. Similarly, in terms of rating distribution, so this is the entire market of, let's say, India. You will find 10% companies in AA3. You'll find another 10% in A1. You got a big bulge in BAA1, it's about 25% of the companies, and then so on and so forth, right? What do you make of the chart? Where are the credits moving? Are more and more companies getting, and you see the green and the orange. The green essentially is the rating for 2009, and the orange is essentially the rating for 2010. And you see the ratings in BAA3 have increased largely from last year. So some companies maybe have upgraded. The ratings in BAA1 have increased. So companies which were in BAA2 or probably earlier lower in BAA3 have got upgraded. And so is the case with A3, right? So if your rating upgrades are happening, you move up the value chain. If the rating downgrades are happening, you move down the value chain, right? You'll also look at what we call as a debt maturity profile. So you look at debt maturity in terms of what kind of maturity is coming for each of these sectors. And see if the big maturity is coming for a particular company, then obviously you don't want to invest or take the chance of refinancing. But otherwise, you try and obviously position yourself on where the debt is coming, right? In this one, obviously, capital market is something which is easy to raise, and bank borrowing is obviously usually renewable from that perspective. 144A essentially is a private placement product, which is not available in India. I mean, there is LODR and other guidelines, but more or less, I think it's more an active US market. So if you want to pick up yield, if you want to pick up duration, that I need, if so and so company has in first half of 2012, if about 4 billion of maturity is coming, that's my time where I can go and issue spreads across the duration, for that particular rating agency, for that particular company from that perspective. Similarly, you look at outlook distributions by industry and sector. So we try and see which industry has mostly positive or negative or stable outlooks. So for example, if metal mining has more negative outlooks than positive, then we'll try and avoid metal mining, right? Similarly, I mean, I can't see anything positive here, but nonetheless, this is how you look at from a outlook perspective, what's happening. Trades introduced. So I told you about relative value trades. So, there are trades, for example, I've got, Banbra PC20 versus Petbra 20. So Petbra and Banbra are essentially, the names of the company or the tickers of the company. And C20 obviously is the call in 2020. And the plain 20 is essentially the majority in 2020, right? So you're looking at, let's say, this is 2010. You're looking at these trades which are happening of two companies which are very similar to rated in terms of 3-month spread of Z-score is about 2.2. Banbra Security has issued about 1.5 million, and the outside spread pickup is 137. So if you move up from Banbra to Petbra, you will end up getting better yield of about 137 basis point, right? Similarly, if you go from CAF to Chile 20, right? Given the countries and outlook and supply, you will basically pick up a spread of about 118 basis points. 1% is approximately 100 basis points. So depending on where you move, whether from which maturity to which maturity, you will find that you can pick up some spread out there. And these can be done for NTPC, IOCL, IDBI, ICICI, HDFC, stuff like that. Just simple pair trades out there. Now, this is the chart on the quasi-sovereign and supranational, right? The quasi-sovereign, essentially the companies which are more or less owned by government, and then the remaining supranational which are supported. And you see the charts over here in terms of the duration and where the Z spread is coming. Z spread essentially is a measure of risk and reward for a particular corporate, and you try and see above rating category which one is better suited when you want to buy or when you want to sell from that perspective. I gave you the example of the pair trade, the Norbra and the Petbra of 15 versus 16. Now you see the difference in spread is essentially the basis. Now, if you are expecting that the basis will revert back to what your April 2011 levels are, then you will switch on the trade. Otherwise, you will not do the trade, right? So that's a classic kind of mean reversion kind of a trade from that perspective. You also look at high, low, and retrace analysis. So I put in companies like Vedanta, Fufang, Lianzu, Longking, MIE, Winsway, West China. You look at the coupon, you look at maturity, you look at ratings, net debt to EBITDA, current price, yield to maturity. Yield to worst in some of these companies as high as 17-18%, right? What's the year-to-date low? And what's the distance from year-to-date high, right? How far it has fallen. And if everything is priced in terms of negative, and if everything is priced in, should we buy? Given whatever we are seeing in terms of leverage, from that perspective. Similarly, you will see that the BB would have outperformed, in high yield crisis because of the higher ratings. Asian high yield would have underperformed in general because money usually moves to US because majority of the investment grades are in US from that perspective, from a country rating as well as from a company rating perspective. You will find commodity-based strategies. So depending on where oil, sugar, wheat, corn, cotton, iron ore, aluminum, and copper are going, you can obviously take a bet on those companies which have underlying exposure to these securities, which is commodities, and take a clue whether you want to sort of be long or short on some of these stocks, given the supply bottlenecks and other things which are happening. This again is a slide on IG Financial and IG Industrials. So when we talk about financials in a corporate sense, we are talking about banks, NBFCs, and other things. When we talk about industrials, it's mostly the manufacturing companies, right? So 2010 to 2011, people, you will see that obviously the spread is always there. Banks always have a higher spread because they're more liquid, they're more kind of, always borrowing and always this thing. But corporate obviously have a lower spread because they're backed by hard assets and they tend to perform lower when it comes to sort of performance over a period of time. Similarly, you manage, map or see what you call a global risk appetite index, which is kind of panic and euphoria. So whenever there is a panic, you end up buying. Whenever there is a euphoria, you end up selling from that perspective, right? You also manage and cover the CDS charts of different countries and different big banks and see whether, they're making sense. Sometimes you get two CDS with one on a subordinate security, one on senior security, and you try and see if you want to get yourself covered, whether you want to buy a senior CDS or a sub CDS. In India, obviously, naked hedging is not allowed, but outside India, if you don't buy a bond, you can also shorten CDS for taking a long exposure or a short exposure in that particular company from that perspective. Country-wise trade, again, you can compare, China, Indonesia, Philippines, some of these things which kind of more or less, action similar when it comes to APAC, and see how the returns are going and where they're going, with respect to year-on-year analysis. Globally, you will try and see where you are getting more coupons. So obviously, Asia typically offers you more coupon in terms of dollar. An average company offers you about 10.5% coupon, back in old days, versus Europe and US. So if you can understand the risk and you have people on the ground, then obviously it makes sense to go for that higher coupon and sense it over there. This is the CDS analysis on majority of the names I was talking about. So you will see in the middle of the chart, you will find ICICI, you will find IDBI, you will also find Thailand companies, you will also find Reliance, you will find other names which are out there. And we try and compare the CDS across these names to see where the 52-week range has been, which company is on the outlier, other side, and see if we can buy or do a trade on a long or a short position in some of those names. So this is the Philippines and Indonesia basis I was talking about. The basis, obviously, there was a huge difference, and now the basis is almost coming. So if you would have done a trade, you would have benefited out of that. Similarly, Korea and China, I've done a basis analysis and shown you where what is happening. The other thing which you try and do is FX volatility and credit spread sort of correlation. So try and see if the currencies are moving together along with the spreads, and if there is a trade which can be done over there, right? And the last part today, which we are covering, is essentially credit enhancement, which essentially includes all methods, actions, which makes it easier to increase or access to the formal market. So if your rating is, let's say, triple B, and you want to sort of access a higher rating, how do you do it? You try and obviously go for a credit enhancement. It could be a structured credit enhancement. It could be an unstructured credit enhancement. You can give additional guarantees. You can give additional securities. You can give additional things which can improvise your credit scoring from that perspective, right? Sometimes it's in the form of equity seed capital. Sometimes, loans on special conditions. So, for example, Japanese government has given a loan for metro project or a bullet train to India on a special condition on a very, very longer term, this thing. Sometimes these are guarantees from parents. Sometimes these are tax reliefs. So, for example, if you set up a zone, special economic zone office, then essentially you get what is called the tax relief, for a certain number of years, which essentially is a tax credit enhancement from that perspective, because it reduces your tax outflow and hence increases your capacity from that perspective. Infrastructure investment, they are considered obviously more social and more emphasized by governments, sometimes with respect to priority lending, when it comes to road, water, sanitary, etc. That can obviously give a credit enhancement to you. You've learned about green bonds and ESG analysis. Some of that is happening. That will give you perspective on why infrastructure gets a special status when it comes to lending, right? Technical assistance and cooperation, I haven't seen much, but these are also the forms of credit enhancement which can add a little bit of credit enhancement when it comes to rating upgrade. Sorry. So there are three types of credit enhancement: level 1, level 2, and level 3. Right? Level 1 is essentially equity seed capital, loans, and guarantees. These are kind of the more riskier ones, because you need to really understand the impact of some of these things and whether they actually make any sense or not. Level 2 is essentially more tax relief and infrastructure. They're plain vanilla because they don't, really, they're kind of more or less defined by the government and there's stated policy. And level 3 is where it is more of qualitative in nature. So it may or may not impact your credit enhancement at all, right? Usually level 3 is never alone. Level 3 has to be with level 1 and level 2 together in order to make a meaningful dent into what rating of which we are talking about. This completes our formal, remarks, from that perspective. I think we have finished a little bit early, but I'm happy to take questions if there are any at this point in time. So if there are questions, you can type in your chat box or Q&A box, and I think we can take those questions as and when I think the moderator provides us.
So we'll take up all the queries at the end of the session.
Yeah, I have completed my proposed slides from that perspective.
Okay. Any other things you want to discuss here for the 5 or 10 minutes?
There are 2 more reports, but you'll have to give me a moment to share those reports, okay? Just
Yeah,
give me
sure.
one. I'll share those. There are 2 reports which I wanted to cover. Just give me one moment, okay? Allow me a moment, okay? I'm just opening up those.
Yes, sir.
I hope you were able to see my screen. Now, these 2 files, we will share it along with, the material on the ground. And bear with me, I'm looking at my other monitor, and hence it might look like that I'm not looking at the screen, but I'm looking at other monitor to explain it to you, right? So bear with me on that. So this document, essentially, I was talking about the rating agency methodology. This essentially was issued by Moody's, and this is the rating methodology for banks, right? It'll have a date, and you can obviously find the latest document whenever you obviously go from there in terms of finding out. Now, see this section, it's a fairly detailed document of about 133 pages, right? It covers almost everything which you need to know from a banking, analysis perspective. Now, if you are a banking analyst, or if you are sort of looking at, credit in banks and want to understand how to obviously, analyze banks, this document essentially is a Bible, for you. This document is something which you can read, and you'll understand what sector and what points and what things are good or bad, right? Look at your this thing. You will have a very detailed. You'll have a baseline credit assessment. You will have detailed fundamental credit factors. You will have structural analysis. You will find covered bonds. You will find related entities, because banks, you will have other entities. How the bank ratings are done. What are the legal aspects of resolution regime? Now, resolution regime is similar to what bankruptcy regime which you talked about, right? Then you have assumptions of LGF. LGF, if you don't know, it's a loan given default, probability which talking about. You look at scorecard ratios. You look at failure. What happens to bank rating when a resolution will fail? You look at asset quality. You look at joint default, or back testing of data. How risky are the banks? What kind of triggers can come in, and all of these kind of details, right? And these are very, very sort of beautifully explained in terms of rating. And I'll show you a method. So you see this. This is very, very useful in India. Hold on. So you'll see, typically banks will try and, the Moody rating agency will try and do a baseline credit assessment of the, company itself, which essentially looking at the financials, operating environments, try to capture their future profitability, etc., right? You look at affiliate support, right? So typically, they might have affiliate support in terms of other banks or other corporates or otherwise. You let up LGF analysis. Remember that, recovery rates and the default rates which you talked about. So that essentially gives you some probability, and you try and find out whether whatever liability you have, what kind of recovery rates you might have. You look at government support. So in India, obviously, usually banks are government supported. And then sometimes whenever that happens, they will come over to rescue. But if that happens, what happens in over there? And then eventually you come up with a rating along with a counterparty risk rating. Counterparty is essentially used for most other places wherever you are doing trades or otherwise. But usually this approach is used for banking instruments. Now, the there are other instruments in BFSI, right? BFSI is a very broad sector. So within BFSI, you will find ratings for insurance companies, you will find ratings for asset management companies, you will also find ratings for, so even the gold loan companies have rating criteria, which is different from this, right? Now, when you're looking at bank, you're essentially looking at lending. Now, within lending, you have some companies which have risk with respect to, lending defaults, whereas some of these companies which are only doing gold loans, right? Gold loans, anyway, you're getting 60-70% of the loan value, and there's no chances of default because gold is obviously at any time liquidatable, from that perspective. So each company in each sector, which will have a different sort of analysis scenario. For private banks, the government support factor is obviously a little bit lower, but it's still there. I mean, tomorrow if ICICI or HDFC goes under, I'm sure regulator is going to come and support, from that perspective. Within BCA, we talked about the financial profile, macro profile, qualitative adjustments, all those things come in picture with respect to, what they look for a bank, right? Well, what the brand image of the bank is, how they're doing with respect to branches, penetration, what kind of CASA ratios they have, etc., will essentially come in picture. Sovereign component, so within every country, there is something called the banking sort of risk in terms of what kind of event risk it might have, credit conditions, funding conditions, industry structures, economic strength, whether the country is doing well or not. And that's where I think they use some of these economic strength factors and other things. So banking obviously are very, very related to sovereign ratings and hence goes from there. In terms of, financial profile, obviously, within bank, you have tons of data, right? You have asset-based risk, capital, so tier 1, tier 2 capital, profitability, which is the NIM ratios, etc. Funding structure, whether you have short-term, long-term, foreign currency, local currency, liquidity resources, solvencies, and other things that you look at. Overall, that will make a financial profile of what you're doing. And each of these have weightages. Now, mind it, each company, each rating agency can use a different weight when it comes to, the model, right? And hence the ratings of each particular bank is very, very different than what you're talking about, right? Now, this is essentially the model which we are talking about. So historically, if you get X ratios, what ratings do you give? If you get Y ratio, what ratings do you give, right? What weightage you give in country 1, 2, 3, what kind of funding weightages you give. So remember, I showed you the Reliance rating model. The Reliance rating model, this is similar like a bank model, which essentially these guys are building and which can give you a perspective. So if you ever want to build a model to sort of analyze bank, this is your way, to do it. The other one I want to show is your, corporate methodology. So this is, I think, S&P has put in this corporates, and again, you can find these rating methodologies from local context as well. From a local context, even CRISIL, etc., everybody would have it, right? So for a corporate criteria, you will see they are looking at country risk, they are looking at industry risk, they are looking at competitive position, they are looking at cash flow leverage, right? So the first three factors in the blue they make what they call as a business risk profile. Cash flow leverage, which is that part of the person and the capacity of the person, is what will make the financial risk profile. Put together, you try and basically, come up with the rating, and then that is, I think, amplified or de-amplified with respect to financial policy, liquidity, governance, comparable rating analysis, diversification, and eventually that gets tagged with, standalone as well as, government influence if there is any, and then the issuer credit rating is, defined. Now, this obviously looks very simple to sort of, begin with, but again, each of them will have a detailed model, and let me show you that model. So, for example, if your business risk is, let's say, they look at this, business risk is excellent from that perspective. Typically, you will try in these 4 or 5 different rating categories, right? So, a single B rated company will never have an excellent business risk profile. A single B company will always have a vulnerable, weak, or a fair or satisfactory kind of a risk profile. It can never have a strong or an excellent risk profile from that perspective. Similarly, diversification. If you are significantly diversified with respect to your revenue, with respect to your business risk, then that will add up to two notches to your rating. Whereas when you are a single location, person with respect to your business, that will reduce your, impact on rating from that perspective, right? Similarly, capital structure, depending on what kind of anchorage and factors you have, what kind of policies you have, you can have 1 notches up, 1 notch down, 2 notches up, 2 notches down based on what you get. And that essentially precisely will will make what a model looks like, right? So a model can essentially change some of these things, in terms of ratings, and eventually they come up with what call a consolidated rating. We talked about one slide in the beginning, which was whether rating was an art or a science, right? Well, rating obviously is a mixture of both. Rating is neither art, it's neither science. It's a mix of both of them. So it's a bit of art because it has included a lot of qualitative factors, and it's a bit of science because it has some model which are available, with respect to capturing, the financial data which is out there. Let me show you something more. I want to show you the financial model. Apologize for skipping this too fast, but I think it's a long document of about 80-85 pages. So going through it entirely won't be possible, but let me show you something. Competitor advantage. There'll be a ratio analysis section. Yeah, so profitability assessment. Again, everything we should talked about essentially is based on relative assessment, right? So relative to that particular industry, if you have above average profitability, your score might be higher. If you below average profitability, then your score might be lower. So profitability, obviously one of the examples, but then you have leverage. Like for example, this one is cash flow leverage, right? So again, cash flow leverage will have a factor in terms of how they are looking at whether it is 6%, 8%, 9%, what kind of time horizon you're looking at. I'm looking for a table if it's out there. Yeah, this is the table. So this is the minimal. So if you see the minimal option over here, so typically for a company, they're looking at a core ratio, then you have supplementary coverage and supplementary payback ratios, right? So you're looking at FFO debt. It has to be like 60 plus. And the debt EBITDA has to be less than 1.5. Your FFO debt has to be more than 13. Now, if it is not 60 plus, it is 45 to 60, then it comes to a modest category. And the modest category will have its own rating mapping. If it's aggressive, which is 12 to 20, or highly levered, which is less than 20, then again, the rating will change from that perspective. On the supplementary coverage, if the EBITDA interest, is more than 50, then it's the minimum required and it'll have a very, very high rating. But if it's less than 2, then it will be considered a highly levered, from a financial standpoint, and obviously have more volatility from that perspective, right? And similarly, you have standard volatility, you have medial volatility, and you have low volatility with respect to businesses or companies that you're talking about. And accordingly, your rating and rating criteria will change, with respect to ratio. Now, these are obviously sample ratios. You can have more, you can have less, and they give you perspective in terms of where the rating is going to go. Now, this is obviously the calculative part of it. The subjective part is essentially the management analysis, right? I'll show you the management analysis, right? Now, so you see on the management analysis, the first thing they're looking at is financial discipline, right? So whether it's conservative, whether it's aggressive, what kind of leverage tolerance they have, what kind of unforeseen actions they're looking at from management, whether they are disciplined, whether they're committed, whether they have capacity to reduce debt, those kind of things you're looking at from a management, perspective. And there are categories, specific categories called, let's say, positive, negative, neutral. So when management is likely to take actions that result in leverage which is lower from your base case forecast, then obviously you put in this as a positive thing. Otherwise, you obviously end up into neutral or negative from that perspective. Similarly, sort of, on the governance part, you look at risk management, you look at we talked about strategic direction, you look at organization effectiveness, you look at governance practices. Let me show you organization effectiveness, and probably that will give you some perspective. So within effectiveness, see, there is an impact of brand reputation and recall also, right? How do you look at your sort of advertisement? What kind of brand measures you're doing? What kind of SLA you have? What kind of product service level quality? Do you have too many complaints? Do you have less complaints, right? What kind of barriers to entry it is there in the business? What kind of switching costs are there? What kind of technological advantage and capabilities you have? Do you have technological displacement? What kind of asset profile you have? Right. Some of these factors essentially will give you perspective with respect to each of these rating agencies. Now, depending on where you go and what you go, it'll happen. I promised I'll show you the Economist, debt clock. Let me show it to you so that you can compare where that has gone. Just give it a moment, it will load up. So you see the numbers which are changing. Now, when I choose a country, so let's say I choose uh, India here, right? So it will show me, what kind of public debt of about 1565. This is the amount of public debt. Public debt per person is about $1,200. Population, obviously, we are now 140, so it's a little bit dated from that perspective. Public debt as a percentage of GDP, that's about 54%. And the annual debt change is about 13%. Take a look this versus, your US. You will see the public debt is like, 15,991, trillion, 15 trillion or so. More than that, 369, that's billion. Yeah, so this is trillion, 16 trillion, right? Debt per person is $50,000, whereas debt per person for India is about $1,200, right? Public debt as a percent of GDP is about 94%. We are about 54, percent from that perspective. So it keeps on, changing, and you can compare country to country here and figure out where and what the global debt and where it is going. Let me show you China, from that perspective. China is obviously more than US. It's about 19 trillion. But, the public debt per person is very, very low. It's about 1450, which is very similar to our, because the population is very, very high, right? Versus US, where the population is low. Hence, the number of public debt is very, very high with respect to that. I can also change from public debt here to just say public debt for per person, right? So if I just do public debt per person, it will show which all places public debt is very, very high, which all places public debt is very, very low. The chart is still loading up, so give it a moment. It'll come up with respect to what you're trying to see. And it also has comparison, so you can also look at year-wise how obviously this has changed, right? So the chart is still moving. Yeah. So you look at the public debt per person in US versus what it is here. Now this data you're looking at is 2005. I do 2015. The data essentially will change, and you'll find the new numbers, out there. Okay. Thank you for having me today. I think we are ready for questions now.
Yes, sir. We have received some queries.
Sure.
The first one is, how does the increased level of reverse repos impact the overall market going forward?
Okay. See, I am not an expert on liquidity, but RBI has been obviously taken various measures with respect to higher inflation, and then to control higher inflation. Obviously, the rates have increased. An increased rate obviously did suck up, whatever liquidity which we are talking about, right? India obviously is still developing from a standpoint of debt and impact of some of these repo, reverse repo, and other things. So far, I mean, we haven't seen anything material with respect to incremental reverse repo and their impact on other things. But I think eventually it remains like more or less of a liquidity measure from RBI. So depending on where they want to go, it will go. We don't have a specific view on, whether this will impact much in terms of yield or otherwise.
Yes, sir. The second one is, are private trading tools likely to increase in importance post COVID-19? Do you see big data as creating an opportunity for more companies to be rated comparatively?
See, big data definitely has helped, right? So, for example, I'll give you an example. In India, if you have never taken a loan in your life, if you don't have a credit card, your personal credit score will be lower than someone who has taken a loan and paid on time. Why? Because your CIBIL score, captures what they call as a loan repayment history. Now, if you have taken an EMI and you have paid 6 months or 3 months, then you have a loan repayment history, and hence your score is better. But if you have never taken a loan in life because you are rich already and you don't need a loan, then your score is low, right? Or let's say you have never been, let's say if you just graduated from your college, right? You're 23 or 24, you just became your CA. Yesterday there were results for CA final, right? 20,000 people have joined the community, right? Do they have credit score? They don't, right? So it has happened in Malaysia and some of these other countries. What they do is what they will try and obviously call for what they call as a social credit score. So they will take access to your data from your LinkedIn, your Twitter, your Facebook, your Instagram, and then try and see what kind of people you are interacting with, what kind of messages you are putting up, what kind of websites you're following, what kind of people you're connected with, and accordingly they'll give you a score. So if you are too much, focusing on religious matters, so too much extremist, too much, on the negative side, then they might show your score as low. But if you're too much on business side, too much on motivation side, following good companies, having good connections, reading about business, then your score might be a little bit higher. Because essentially, you don't have any numbers on capacity right now. But again, come on, they are trying to assess character as well, right? So as long as the character is good, eventually the guy will end up going and paying. You would have seen that a lot of these credit card companies, they go to very, very good campuses like, let's say, IIM Ahmedabad or Bangalore or SP Jain or something, and they offer free credit card to pretty much everyone, even though they know that these students may not have any income proof at this point in time. But their point is, if you are graduating or post-graduating, doing post-graduation from a very, very reputed good business school, then you're likely to land up in a good job, right? When you land up in a good job, that time you will have multiple companies to offer you a credit card, right? But right now you don't. So right now, if I offer you a credit card, you will become my preferred customer for life, right? And this strategy was done by Citi and some of these SBI and some of these other corporates. So yes, post-COVID, obviously there is a lot of data which is available out there, which is being used by some of these agencies to sort of give you perspectives on credit score. But have our credit models evolved? No, right? Because every bank is generating tons and tons of data in terms of UPIs, in terms of ATM withdrawals, in terms of expenses pattern. Are they using it right now? No. Will they eventually use it? Yes, at some point in time, right? I don't think right now we have started using it, right? So in US, in some of these banks and other places, if you go, they'll essentially, on the phone itself, they will run a background credit model and give you an offer on something which you might have tracked or which you might have, expensed out very soon. In India, I think we are still evolving from that perspective. So big data eventually will come and that will determine a lot of these things. But India has some time to go. I mean, we are catching up very fast, but maybe another 2-3 years.
Right, so the next one is, do you anticipate a cascading effect of the poor credit returns on the global banking system?
Unlikely. I mean, unlikely because, this is the time for banks to make money, right? Whatever happened in GFC, banks obviously at that time were not prepared. Corporates were not prepared. Corporates were very, very highly levered. Over the last maybe 10, 12 years, corporates have obviously reduced their leverage by almost 30-40%, and the corporate profitability for the first time is inching up on a higher side. So I don't see that some of these things will have a cascading impact on the profitability. In fact, if at all, it will be on the positive side. Whenever interest rate cycle is high, banks always make more money. Now the corporates might make less money because of the interest rate burden, but that anyway won't come because the leverage itself has gone down in the system itself, right? Post COVID, everybody thought world is about to an end. So the first thing they did was pay off all their debts, right? Banks also at that time called for money, right? So banks are sitting on surplus liquidity at this point in time, and they don't have avenues to obviously deploy, right? At the same time, rates have gone up. So I don't think the profitability is getting impacted for banks. I mean, you see the prices of most of these PSU banks, everybody has gone through the roof.
Right, sir. What will be the key drivers of SMEs and startups to access more credit, and which KPIs should be considered?
See, I think GST is one of those KPIs which is kind of working out for everyone. With the digitalization of GST and income tax, majority of this e-way bill is giving lenders the right set of data in terms of what your actual sales are, right? Whether it is you're lying, you're doing what you're saying, whether your goods are moving, actually everything can be tracked on a real-time basis. So especially for SME, data on GST essentially has helped them really in terms of producing this and claiming the authenticity of it, right? The second is, this PLI scheme, obviously it's not very effective for small, medium enterprises. They are not getting that much benefit of it. But, from a government perspective, this Make in India initiative, for doing, 30% or 40% things from, uh, uh, in defense or majority of the sectors, along with, countervailing measures on other countries and, review of these FTAs. You won't believe, I think there are like about 13 FTAs which have signed so far. I mean, it's starting from early 2000, and government is focusing very very hard on some of these FTAs, whether they are helping our corporates, our SMEs locally, because that's where a majority of the job creation is happening. So for SMEs, I think GST is one with respect to access to credit. But other than that, I think majority of it is all digitized, right? The payments are digitized, the costs are lower, labor availability is cheaper. The factory laws have been simplified. So the ease of business ranking obviously has been going up and up and up, right? Which obviously helps them kind of do business faster and better, right? On top of that, there are separate schemes where they can register as a startup or otherwise and get a variety of benefits from government.
Yes, sir. So the next one is, why is periodic credit review is important for the low risk customer accounts where the organization are quite safe and secure?
So typically for every client, whether it is PMLA, whether it is credit, whether it is any other type of security, all clients are categorized into high risk, medium risk, and low risk, right? So for example, I'm talking about PMLA. For PMLA, if you are a low risk client, your PMLA checks and your KYC will happen once every 7 years. If you're a medium risk client, it will happen once every 3 years, right? If you are high risk client, then it will happen once every year. Correct? Now, each bank, each financial institution would have categorized you as high risk, low risk, or medium risk. That will depend on your profile, whether you are salaried, business. That will depend on what level you are, senior management level, started working, not working. That depends on your credit habits, how much you are spending, not spending, whether you are using credit cards. And that will depend on the type of the product, whether it is home loan, whether it is personal loan, whether it is car loan, right? The least amount of risk the bank would expect is someone who has taken a home loan, right? Because someone who has taken a home loan is essentially residing in that home, right? He's not going to mess up with his own residence from that perspective. But if it's a personal loan, it's a credit card loan, they will reassess this every time you're doing expenses to see your pattern, right? So depending on what kind of risk categorization you have in your bank, the credit analysis or credit, reassessment will happen, right? And sometimes it's a matter of, just doing it based on the system, because if you have a discipline in place. So for example, all of these NBFCs these days report monthly data to, all the CICs, which is the credit information companies. And monthly, these companies essentially run their model and update it. So this month, let's say if you have very, very high usage on your credit card, you see the score next month, it will be a little bit lower by 5-10 points. Next month, you have paid off everything and you have zero outstanding on a credit card, your score will again go up. Now, because score is being used, by almost everybody out there who's looking at credit at this point in time, they are updating this constantly. So if you expect them not to do anything for like 1 year, 2 year, 3 year, your data will be stale, right? And whosoever is relying on that credit information scoring or rating would be completely different. For non-individual, the case is different because the results are only available once a quarter, once every 6 months, or once every year, right? So they have to wait for that much time before they incorporate that results and get financial analysis. But for individuals, it happens very, very quickly and very, very on a real-time basis. You do a loan inquiry today, you do a credit card application today. Next thing you know, 10 days time, it will be reflected in your scoring from a credit perspective.
Yes, sir. So the next one is, considering the gray areas of traditional credit risk management system, why big and large corporates use traditional method in modern area?
Can you repeat that part?
Considering the gray areas of traditional credit risk management system, why big and large corporates use traditional method in modern era?
I don't think there are gray areas in credit. I mean, majority of the things are very clear. You are essentially looking at only two things: ability to pay and willingness to pay, right? And most firms now have these systems in place, whether it is for only counterparty. So, for example, if I do business on credit, how much credit I'm supposed to give it to you, right? 3 months, 6 months, how much goods exposure I should have it with you, right? So different corporates are using different mechanism, but they're using the same thing. They're using the same 4 pillars, right? Large corporates will call it counterparty risk, right? Banks will call it general credit risk. Other people might call it differently, but the risk is same. You're just using it for different perspectives. I don't think there are gray areas with respect to how you analyze. The only gray areas could be for industries or companies which are new. So, for example, if Zomato comes to you and say, I need a loan, right? How do you analyze Zomato? Do they manufacture anything? No. Do they have a workforce? No. Do they, are they in profit? No. Right? All they have is data. All they have is number of clients. All they have is so many millions of orders delivered every month. All they have is number of cakes delivered, right? Now that's the big data. You will have to find out a value somewhere saying that eventually this company will be going to pay me money. Now, this is one of the reasons why some of these startups never get debt funding in advance. They always get equity funding, because for debt, you need capacity, and they don't have capacity because they're making losses. Somebody needs to fund their losses to get it. So for new businesses, it's very difficult to analyze credit because the traditional credit model doesn't fit in there only. So there only you can do startup funding, right? Credit models will never work on these new age businesses. Credit models only work on businesses which are existing, which are already showing some profitability out there, right? For newer businesses, credit score will always give you a wrong picture. It will give you saying that the business is going to go bankrupt, right? Because if the business is making losses for like 1 year, 2 year, 5 year, your loan duration is 5 years. For 5 years, you're never going to get money. The only hope you have is some bigger fool is going to come and give money and bail you out, right? But credit analysis cannot be done in new age businesses or startups, as you call it. Yeah.
Yes, sir. So the last one is there any famous software, tool, or application in wide use that measures credit risk efficiently?
No, unfortunately, there is no special software because everybody has a different definition of how they analyze credit risk, right? So, for example, like I said, interest coverage ratio, there are like 20 different definitions being used in industry. The banks use it differently. The global rating agencies use it differently. What CA textbook teaches you is very different. What Moody's uses is very different. What CRISIL uses is very different, right? So it's very difficult to standardize the software. The only thing standard is how the data is presented. Most of you must be aware of what a CMA data is, right? So the CMA format data is being given to banks and they then use it to go from there. But there's no standard format or methodology which you can develop. I mean, you have the tools of how you can develop it. You can do it in an Excel. You can do it in any other place. You can use 5 factors, 10 factors, 2 factors, 3 factors. But there's no standardized software. Most of that is in-house. Because this is the IP of some of those people, right? If you have an IP, then it will be very difficult to, put out what is needed there. So I'm sorry, there's no software out there.
Okay, right, sir. So we have taken all the queries. Now, I want to say thank you. Thank you for giving your precious time and sharing your experience. And I want to say thank you for enhancing the practical aspects of the members on a very important topic. A formal word of thanks from the Committee on Management Accounting.
Thank you to CMA and thank you to Gyanji for inviting me and Rajendra ji, and thank you, ma'am, for asking all the questions and summarizing, members' queries. And thank you to everyone who was attended.
Okay, thank you so much.